One, just want to make sure that everyone can hear me before we get started. Maybe if you could just acknowledge if you have any troubles in the question box. I'll give it a minute or so, and then we'll begin here. Perfect. Thanks, everyone. We'll get going here. It's 12:15 right on the dot. So again, my name is Tanner Coles, and I'm a senior mortgage advisor here with Dreher Group Mortgages. Just a little bit of background on myself. I've been in the financial industry for just about 11 years now. I've worked for major financial institutions and various mortgage brokerages as well. So definitely have experience on both sides, coming from the banking background in particular, and also from an independent advisor standpoint. The two models have different views of mortgages and how clients are handled. So it's good to have a well-rounded background to that respect. If you have any problems or if you have any questions at all, please just wait until the end. There's a little question box that you can see, and you can always type in your questions there at the end, and I'll certainly give about 5 or so minutes to address them at the end. So to that effect, we will get started. As you know, we are talking about the new mortgage rules and how they may affect you here moving forward. So what we're going to do is take a trip back to 2008, and I'm going to move forward right up until 2016. So what I want to do is highlight all of the mortgage rule changes that have happened in the past several years and why, and of course, how these rules might affect you. So first and foremost, we know that the new set of mortgage rules started being implemented in 2008. This is right around the U.S. crisis with the housing meltdown. What happened there are Canadian financial institutions, and more so our government, were very nervous with what was happening with our neighbors, and they did not want to see us end up even close to the same situation that the U.S. went through and are actually still going through. So what happened is they really started to tighten up our mortgage lending guidelines as a protection measure. And I'm going to say that the first set of rule changes here in 2008 are actually a very good thing. So back in 2008, I'm sure some of you might remember that you could actually buy a home with 0% down, and you could amortize your loan over 40 years. So essentially, you were buying a home on credit 100%. You had no equity within your property. And so if the housing industry decreased slightly, you're now underwater. You now owe more than what your house is worth. So a bit of a dangerous territory there. And of course, 40 years to pay off your mortgage is a very long time. So what they did is they increased the minimum down payment amount to 5% of the purchase price, and they also reduced the amortization period from 40 years to 35 years. Now, the next set of rules was to help with speculation. So what was happening where people were buying properties left, right, and center, and I'm talking your average person or your average couple. They were buying their principal residence, and with only 5% down, they could buy a rental property or even another rental property. So again, as you can see, we were having lots of Canadians accessing property with very little equity. So again, if there was any downward trend in the housing market, they were going to be in big trouble, and they could potentially walk away from their home and hand the keys to the bank. So to that effect, the government reduced the down payment requirement for rental properties to 20% from 5%. So this was a very big change in itself. And also for refinances. So only 6 years ago, you could refinance your home up to 95% of its value. So maybe you had 20% of it paid off or 30% of it paid off. Well, you could again take out almost all of your equity if you wanted to. So what they were finding were Canadians were actually accessing their homes like an ATM, and it was quite easy. So they would borrow from their home, pay down a little bit, borrow from their home again. As you can imagine, this is also some scary territory that we were seeing. So they lowered the refinancing position from 95% of the value of your home down to 90%. So a little change there, not huge, but you can see that they were having some concerns there. And this was also a big one in 2010, and that has to do with the qualifying rate on variable rate mortgages. So back in 2010, and this still holds true, if you were applying for a variable rate or any term of less than 5 years, you would still get the discounted rate if you qualified for it. But the lenders would have to put you under a stress test. So just a quick example here. Let's say you were applying for a 5-year variable rate and it was 3%. Well, if you qualified, you would get that 3%. But we had to stress test you at, let's say, 4.5%. So we had to make sure that you could qualify should interest rates go up all the way to 4.5%. So what that does is it just reduces your purchasing power, but it is a protection measure, of course, if you're in a fluctuating term. And they did the same thing for any term less than 5 years, even if it was fixed. And again, this was to mitigate speculation. So a lot of investors or home buyers out there looking for quick flips and things like that. Now, moving forward here to 2011, there were some changes in the high ratio market. So what this means are anybody purchasing a home with less than 20% down. So that would be considered a high ratio mortgage. So here again, they're reducing the amortization. So if you remember back in 2008, you were allowed 40 years amortization, then it went down to 35, and then it went down to 30. So quite a big change here in just 3 years. So what this does is it would increase your mortgage payment, but of course it would also shorten the lifespan of your loan. And the refinancing was also reduced yet again. So we went from 95% to 90%, and now back in 2011, you can only access 85% of the value of your home. So again, some big changes happening in a very short period of time. On to 2012, more changes to the high ratio mortgage market. So only 1 year ago, you had a maximum amortization of 30 years, and now they reduced it to 25 years. And this rule still holds true. So if you're buying a home with less than 20% down, the maximum amortization you can qualify for is 25 years. And the gross debt service ratio was also made, wasn't necessarily changed, but it was made more firm. So now, again, if you have less than 20% down, your total debts, so any car loans, lines of credit, credit cards, including your mortgage and property taxes, cannot exceed 44% of your gross income. And this still holds true as well. Now, some more changes in 2012, looking at refinancing again. So just backing up, we went from being able to refinance up to 95% of the value of our home all the way down to 80%. And this also holds true today. So as of now, you can only refinance up to 80% of the value of your home. Now, this is not necessarily a bad thing, but again, it's to prevent us from continually accessing the equity in our home and protecting us should market shift or should anything happen within your personal life that may affect your income. And in 2012, this is also a very big change with respect to high ratio mortgages, and this is also the same as it is today. So if you're buying a home and you have less than 20% down, the maximum amount you can buy for is $1 million. So if you're buying over $1 million, you have to have a minimum down payment of 20%, and the down payment requirement actually increases as you go over $1 million. Now, this also was not a bad change whatsoever, because if you are buying in this price range, $900 million plus, you really should have more than 5-10% down. So this is really what they're saying is, okay, our CMHC rules are for people to enter the market and not necessarily a higher end market. Now, we're going to look at December 2015, only 1 year ago, or just about 1 year ago. And this was one of the most recent changes with respect to the down payment requirement. So this is also not a huge change, but something to be aware of. So back in 2015, you could purchase a home under $1 million with only 5% down if you qualified for it. Now, the government has changed that slightly. So what happens is you're allowed to put down a minimum of 5% on the first $500,000, and then anything over $500,000 and up to $1 million, you have to have a 10% down payment on. So it's not a huge change, but again, if you are purchasing over that 500,000 mark and you're getting into, let's just call it the more expensive territory, especially as a first-time home buyer, it's probably a good idea to have a little bit more than a 5% equity position within your home. And this is what the government has really reiterated here. Now, this is just a really quick example for what has happened as of October 17th. So again, this is a very recent rule, just came in last month, and this is for high ratio mortgages. So again, anybody purchasing a home with less than 20% down. So similar to the variable rate mortgage qualification standard, now you still might get that discounted rate. So I'll just use 2.5%. So let's say you qualify for a mortgage at 2.5%. That's great, and you will still get that interest rate on your mortgage. However, we now have to stress test you. We have to qualify you at the Bank of Canada benchmark rate. And today that rate is 4.64%. So let's look here at the annual income of $100,000. So let's say you have a household income of $100,000. Before October 17th of this year, you could purchase a home for about $560,000. Now, today, you could qualify for something around $445,000. So as you can see, this is a very big change. It's over $100,000 in the purchase price, which is about 20%. So this rule is a very significant change, especially for home buyers that have less than 20% down. And as you can imagine, a lot of that would pertain to first-time home buyers. Now, there's another change that is coming in a few days here, and it hasn't been talked about too much in the media or within our industry. There's a few reasons for that, but this is really good to know as well. So this change is for any insured mortgage. So what this means is any mortgage that has less than 20% down, or any mortgage lender that insures their mortgages. So as an example, this is not common knowledge, but we have access to about 40 different lenders in total. And some of those lenders insure their mortgages with CMHC behind the scenes, so whether you know it or not. So let's say you were buying a home with 50% down. Well, you might not know it, but some lenders will insure the mortgage through CMHC. So now what they're saying is, as of November 30th, if you have a down payment of less than 20%, or if the lender is going to insure that mortgage behind the scenes, the maximum amortization period is 25 years. The maximum purchase price is $1 million. It must be an owner-occupied property, so no rentals, no vacation property. And you have to have a minimum credit score of 600. Now, 600 is actually a fairly low credit score, so there's a bit of flexibility there. And of course, this is something to speak with your accountant on to be absolutely certain with the tax laws, but you may still be exempt from any capital gains from the sale of your primary residence. The only difference is now is that we have to, not we, but you have to report your sale to the CRA. Now, this doesn't necessarily pertain to mortgages directly, but it's certainly good to know for a foreign buyer. So perhaps you might be a foreign buyer, or you know somebody that is looking to enter the Vancouver market. Now, something to remember is that this is only for the Metro Vancouver area. So any foreign buyer that is looking to buy property within the Metro Vancouver area is subject to regular property transfer tax plus the foreign buyer's tax of 15%. So this is very significant, and we have seen this cooling the Vancouver market area. It's not the only reason why the market has cooled in the Metro Vancouver area, but it's certainly a significant reason why we've seen this lately. Now, we are noticing that foreign buyers are looking elsewhere now to purchase property to avoid this 15% tax. So, example, Vancouver Island, Squamish, Whistler, even across the country in Ontario. So things like this. Now, we've talked about the rule changes specifically. Now we want to talk about how they might affect you. Sorry, go back there. So really, the most important part are going to be for first-time home buyers or anybody that has less than 20% down. It is now more challenging for you to enter the marketplace because of the new stress test. So if you are thinking of purchasing a home or you're not quite sure, speak with a mortgage professional, have them stress test you, go through that pre-approval process, and see what you could potentially qualify for. If you were pre-qualified prior to October 17th, it's definitely time to get a second look at your pre-approval application and see what you would qualify for now. Refinancing, how these rules might affect your refinancing has to do with the low ratio insurance, which we just spoke about. So again, if you are with a lender that insures all of their mortgages and you want to refinance your home, let's say for debt consolidation or home renovations, you might have to leave that lender now. We might have to look elsewhere for you, looking at a lender that does not insure their mortgages. So that means that, if you need a 30-year amortization, we'd have to go somewhere else. And of course, with renewing, we're not 100% clear on how these new rules are going to affect renewals. That is still being looked at by our finance minister. And I will say that a lot of these changes are still being looked at very closely by the Canadian government and by our industry professionals as well. So as it stands, the rules that we spoke of are in place or will be in place as of November 30th. However, some changes could be made, I would say, within the next 6 months here. However, that is yet to be determined. If and when any changes take place, we will certainly update you and update our clients via our websites and other mediums such as email and social media. So I know we talked about a lot here. Some of it can be confusing and some of it can be a little bit dry. So what I would like to do is open up the floor to you and answer any questions that you might have. All you have to do is type your question in the question box, and I will get to as many of them as possible in the next few moments here. So please go ahead. Okay, so it doesn't look like we have any questions at this point in time. If anything does come up, oh, sorry, just one popped in here. Okay, so the question is just confirming that, asking if it is more difficult for first-time home buyers to purchase because of the shorter amortization and the debt service ratio of 44%. And yes, to answer your question, the bottom line is it is more difficult for a first-time home buyer or anybody with less than 20% down to purchase a home today. The reason for that, yes, the amortization period of 25 years, the 44% debt servicing, but really the most important change here was the stress test. So for a first-time home buyer, where you might get 2.5% on your mortgage rate before October 17th, you could qualify on that rate as well. But now you have to qualify at almost double that interest rate, so about 4.64%. So again, that reduces your buying power on average by about 20%. Okay, so I don't see any more questions coming in at this point in time. If anything comes up, you're always welcome to call us, or you can send an email directly to myself, which is tanner@drehergroup.ca, and it's just TANNER @drehergroup.ca. Other than that, I believe SFU will be sending out a recording, and you're welcome to share the recording or listen another time. Thank you very much, everybody, and we look forward to hearing from you shortly. Bye-bye.